Hi folks, let's see if we can make a little bit of sense out of chapter 7, Risk and Return. First, we want to end this chapter understanding a little bit about what risk is, why it's important to understand basically the concept of risk itself, how it's calculated or measured, the different types of risk that exist, and explain or identify some methods that can reduce risk, whether we're running a company or whether we are a financial advisor that is managing somebody else's money. On that note, I'd say it's important that you understand these concepts. This chapter and chapter 8 are really important. But you don't have to understand in this chapter how to calculate probabilities. You need to understand the concept of risk and risk aversion and definitions like beta, so that when you do hire a financial advisor whose job it is to understand these things in detail and to keep relevant information on hand, that you can have a intelligent, germane discussion with them around these issues. And then finally, we'll take a quick look at how firms compensate for risk. Now, a couple of times in the last 2 times that we've met, we've discussed the concept of systemic risk, and that is that contagion can occur within an industry or within the marketplace in general and spread from company to company. For example, we talked last time briefly about AIG, which is was a big insurance company at the time that the collapse of the real estate market occurred in 2008 to 2010. And because their job was to insure different properties and different portfolios, they ultimately failed because there were so many properties that they simply didn't have the assets on hand to cover all their obligations. That was also true for a couple of the banks. Well, actually, numerous banks. But what the government did is they stepped in and they flooded the market with cash so that these companies, some of them, select companies, could survive. So systemic risk can never be diversified away completely. There's always the possibility that something like that could occur again. I had mentioned in that last class the term black swan, and what happened in 2008 to 2010 was in fact a black swan. A black swan is a catastrophic event that occurs that's completely unpredicted and unexpected. Something like war or a disease that was to spread or were to spread at a rapid rate and was uncontrollable would be potential triggers of black swans. So our expected return is the mean of the probability distribution of possible returns. So what does that mean? And future returns are not known with certainty. The standard deviation is the measure of this uncertainty. So in statistics, you had standard deviation, and you should have a concept of variance. So to calculate expected returns, compute the weighted average of possible returns. I would suggest you go to page 138 and 139 in your text. There's no slides on these pages, but if you're looking at it while I'm speaking, it's a little bit easier to get your arms around. So what we want to do is we want to calculate weighted average of possible returns, and this is the formula where your expected return, your overall expected return, is equal to the sum of all the variances or possible outcomes of return within a given period, and then a probability of each of those variables occurring during period I. Usually it's calculated for a year. So if you're just looking at one company, let's look at the Zumwalt Corporation. And what they're saying, what this company is trying to predict, is their likely return through a given year. And they're looking at, collectively, they're analyzing economic data within the realm of their particular industry or region or a combination of all those things in which they operate. And they're looking at these four potential outcomes or variables. The outcome of an economic downturn, the outcome of zero growth, moderate growth, and then high growth. And then they attach, this is all they, and what you often see in the marketplace is you get lots of financial advisors doing their own thing. They're selecting these figures that you're seeing on each side, the variables as well as the probabilities, and then all of their analyses are averaged, and you get an overall prediction. You can get an overall prediction. When you look up the analysis for stock market analysts of different companies, they all have slightly different predictions because these are subjective numbers that they ultimately use. So in this particular instance, it's Zumwalt looking at itself, its interior financial advisors, and let's say he or she determines that there's a 10% probability of an economic downturn, which for them would result in a 5% reduction in their business. A zero growth outcome for the economy or for their sector would result in a 5% growth. Moderate growth for the industry or the sector or the economy in general, however they're defining this, they rated a 40% probability, which would give them a 10% growth outcome, and then a high growth outcome of 30% probability, which would result in a 20% growth for them. And so what they do is they look at these and they multiply one by the other. So if there was an economic downturn and with a 5% loss, there's a possibility within these four scenarios of a decline of 0.5%. If there's zero growth and if there's a probability of 20% of zero growth, and their return would be estimate their return within that outcome is 5%, then remember this is a weighted average, so that they would give them a 1% return. See, they're averaging all these different outcomes of economic possibilities. And they do that for each of these until they get a most likely outcome for the upcoming year of 10.5% return. And the formula for that is this. I don't expect you to remember this, but again, for those of you, if you're going to save a book, save your finance book, because again, if any of you ever do actually start to accumulate some money and you have a financial advisor, at least you can go back again and get an idea of how they come to these estimates. And so the expected rate of return on that particular stock is 10.5% given this weighted average method of calculating rate of return. So risk is the potential for unexpected events to occur. And if two financial alternatives are similar except for their degree of risk, most people will choose the less risky. And that's not unusual. Most people don't like risk. They call that risk averse. Some people, entrepreneurs in particular, generally have a higher level of risk tolerance. But risk averse investors will require higher expected rates of return as compensation for taking on higher levels of risk. So that goes back to a well accepted truism that we've talked about earlier, that if you have higher risk tolerance, you want higher rates of return. And if you have low risk tolerance, you have lower expectations. The old part of something's better than all or nothing. So let's take a look at the standard deviation and review quickly what that's all about. So what the standard deviation of a data set tells us, and this could be, let's say it's IQ, that you have the mean, in which case in IQ the mean is 100, and if you went one standard deviation to the right and one standard deviation to the left of the mean, 65% of all the population is nested in that area. If you go one additional standard deviation in each direction, 96% of the outcomes are nested in that situation. And if you go yet one more standard deviation out, you capture 99.99999% of all possible outcomes. So if you're looking at the page 138 in the two graphs, what you really want to know is the standard deviation for each, the size of the standard deviation for each. And over the next 2 pages, they calculate the standard deviations for each one. The one for company column is 155, and the figure for the next one, company bold, is I believe 357. It's noted on page, or 385, noted on page 140. So that tells you that if you looked at 1,000 as the mean, that if you went 155 in each direction, to the left and right, that 65% of the potential outcomes are nested in that area. For the other one, it's 385 in each direction. So I could almost do the math in my head and say that it's to the left it's 640, one standard deviation is 642, and to the right it's one standard deviation is 1385. And so between 65% of the potential outcomes will occur between 642 and 1385 for bold, and 845 to 1155 for the first one. So without looking any further, you can tell that the first one is much safer. It's a much likelier outcome. If you want safety and if you are risk adverse, the range of something going haywire is much narrower for company calm than for company bold. On the other hand, if you are betting on a really good possible outcome, the extreme for company bold at 1800 is the estimated potential best. But on the other hand, there's an equal probability that sales could only be 200. And so there's a lot of risk in that. So there's two kinds of risk that you can try to manage for: firm-specific risk and market-related risk. Stock price is likely to rise if overall stock market is doing well, and stock prices will fall if a major government contract is discontinued unexpectedly. There's a lot of risk in the marketplace right now as contracts that relate to the government, as it's unclear what President Trump is doing on a lot of different kinds of things. So there's a lot of market-related risk. So from a diversification standpoint, you can mitigate that risk if you have in your portfolio a wide selection of different kinds of stocks. That's the long and the short of it. Or if, well, that's close enough. And even then, you can't get rid of all the related market risk. So when we put together our portfolio, we want to look at two things. We want to look at the overall risk in the marketplace as well as the overall risk of individual stocks. Now the stock market, the extent to which it rises and falls is made up of an index of stocks such as the S&P 500. So when those particular stocks go up, on a given day, it's really an average of the 500 stocks that make up um, the Dow 500, and it's a weighted average of how much they went up in a day and what their size is at any given time. So there's another Russell 2000 is another commonly used um, index. Some people prefer it more because it embraces obviously a lot of smaller companies, so that it's not affected by the loss on a given day of a company the size, say, of Procter and Gamble or IBM or Apple or something like that. Market risk measures how individual stock returns are affected by this market. And there are ways mathematically to, using primarily calculus, to figure out individual returns and overall expected returns of portfolios or market sectors, whatever. So the most commonly used market risk measurement is beta. And beta is just the extent to which your stock compares in risk to the market as a whole. So the market as a whole mathematically is just set at 1, is how you can see it. And if a stock has a beta larger than 1, then its risk is higher than the market. If the market collective average is overall is 1, then a stock with a beta greater than 1 would presume to be riskier than the market as a whole. On the other hand, the reverse of that is a market beta, a company with a beta that's less than 1 is expected to be safer than the overall market. Which is what I just said here. So just real quickly, looking at a couple stocks. Walt Disney, they tell you the beta is 1.2, so it's a little riskier than the overall market. So if you wanted a really good diverse stock within its own portfolio of features that would give you a fairly decent return, Disney's a good one. Disney actually was one of the first big stocks that Warren Buffett invested in the 60s. Another one was American Express. I have to look hard to see what this is. This is IBM. So their beta, I'm sorry, this is either Procter and Gamble or IBM. It cut off at the top, but its beta is less than uh, the market on average. So what you can do if you know the betas like this and you want to put together a portfolio, if you said I really like Procter and Gamble because it's safe. It has a beta. It doesn't. Its stock price doesn't fluctuate as much as the market as a whole. Uh, then I want to own some of that. But I want to also look at some stocks that have a slightly higher potential than the market. So I might look at something like Disney. And then if you had the same amount invested in each one, then your beta would be the average of those two betas, the beta of the portfolio. So within a given portfolio, there are numerous things that we can do to diversify our risk. We can look at different sectors, look at different companies, um, considering their beta so that we can um, try to minimize the overall risk. Now, if you're looking at just the company itself, there are different things a company can do to reduce its internal risk. Uh, for example, it can reduce the volatility of its fixed costs or the volatility of its sales. You can reduce. So, if you're a ski resort, you might reduce your risk by not just relying on a good season, I'm sorry, on a good snow season. You might also have some off-season activities, summer activities like hiking and stuff, or horseback riding and camping in your area to generate revenues off-season. Um, Insurance is a way to reduce your risk, but again, remember, if you get systemic risk within an overall uh, sector or the overall economy, that doesn't always help. But on a individual basis, if you have exposure, say, um, to consumer liability, then you'd want to have some insurance. And again, you can simply diversify uh, your product base. If you're a sporting goods store, you don't really find too many sporting goods stores that focus only on soccer, for example. You usually have sporting goods stores that have a multitude of different sports that are represented within the store. And if you're an investor, again, you can diversify part of that risk away by making sure that you have a good selection of stocks. And if you were to just randomly select 20 stocks out of the Fortune 500 or the Russell 2000, you would have very little risk left over. But the risk that is left over that you simply cannot diversify away is non-diversifiable risk. So hopefully that helps a little bit. These are the concepts that I want you to be aware of. I don't expect anybody's going to remember how to calculate standard deviations or weighted averages for companies. But again, if you get to the point, if you're ever going to be a financial advisor, you'll need to have that level of sophistication. But if you just want to manage your own assets, or you want to converse with whoever you've charged to do that, then they should have these kinds of technical skills.